Hello and welcome to smartmoneyresults.com. I am Kenneth Amaduri and I am your host here at Smart Money Results. I am fortunate today to be joined with Alexander Green of InvestmentU.com. He's the chief investment strategist there, and he's just brilliant when it comes to the ideas and really thinking through a lot of things and strategizing in such a way that will make you very, very wealthy. And I'm fortunate to speak with him today. And Alex, thanks for joining me.
All right, thanks for having me, Kenneth.
Alex, a lot of people aspire to be wealthy and to own their own business and invest successfully, but some just can't seem to get over that mountain of actually being able to do it. And you are someone who started off in the middle class realm and had to work your way up. And I'm curious if maybe you could just share your story and talk a little bit about it and inspire some people who want to make those steps and achieve some goals and get past the middle class rat race that they're stuck in.
Okay. Well, I probably should begin by saying that I did come from a middle class background. It's funny, I had some guests at my house this weekend, and my daughter was having a fit because our guests were going to use her shower, and she just thought that was sacrosanct. And I had to remind her that I grew up in a house with 6 people in one shower, and so that was nothing to get icked out about, because that was just everyday life. But the way that I got out of the middle class is, first of all, I educated myself, not just with formal education, but I went to Furman University in Greenville, South Carolina. I was a business and psychology major, but I'll never forget that on the day that I finished school, when I was getting my diploma, at the ceremony, the president of the college, John E. John, said, "Congratulations, you've just completed your first step in the lifelong process of becoming educated." And I really sort of have taken that to heart. I really think that the first step to having a higher income and a higher net worth is to make yourself more valuable as an employee, or as an entrepreneur. And that means learning everything you can about whatever it is you've decided to specialize in, and then putting that knowledge to good work use, either as an employee for someone else or to go into business for yourself.
Sure, I guess even being in business for yourself, you're always employed by whoever's paying you, essentially. So it's important to always being bettering yourself as an employee.
Yeah, that's a good point. And I should also add that the most successful employees, the ones who tend to rise the highest, are ones who actually manage their day-to-day activities as if it's their own company. Even if you're working for a big company, if you're trying to manage things as if it were your own company and you're really trying to maximize profits, you become more valuable to your employer and you become better paid.
Sure. You know, you're an investment strategist over at Investment U, and I'm just curious, for the audience and for myself, what sectors do you like when it comes to investing your money?
Well, I like the stock market generally for one very important reason, and that is most people, especially when you're talking about people who are middle class or less, or maybe upper middle class, most of them simply don't have the money, the time, or the expertise to start their own business. It's a well-known fact that 4 out of 5 businesses fail in the first 5 years. It's a dog-eat-dog world out there. But the beautiful thing about the stock market is it allows you to own a piece of the most profitable companies in the world. So you can own a whole portfolio of technology companies and manufacturing companies and retail companies and financial companies and so forth, whereas most people believe if they start their own business, everything is tied into that one sector. And someone might start a construction business, for instance, and make very good money for a while, and then the housing market bursts and you've got no income whatsoever. So the beautiful thing with the stock market is it allows you to be a business owner without taking out loans and hiring employees or managing them or hiring accountants and lawyers, or even having to show up for work, for that matter. How good is that? So the beautiful thing about the stock market is it is the essence of capitalism, the private ownership of the means of production. And so I'm actually making recommendations to investors every week about where the best places are to put their money in any given time.
Yeah, that was interesting. Great response. I and along with my subscribers, we tend to be concerned about the financial state of our economy and investing in different things. And, I'm curious, what aspects do you see booming over the coming while? Do you see anything happening in real estate, any specific sectors when it comes to stocks, or what exactly do you focus on?
Well, I would probably begin by saying that I would suggest to your listeners that it's a tough game to try to predict what the economy is going to do and what the stock market is going to do. I mean, even the experts tend to get that wrong. Right. And one of the ways that we've had a great deal of success in the stock market is saying, quite frankly, that we can't know with any certainty what GDP growth is going to be or where the Dow Jones Industrial Average will be in 6 weeks or 6 months. Instead, we buy the companies that, for example, the insiders are buying. When a president, a CEO, a chairman, a chief legal counsel is buying lots of shares of their own company stock with their own money at current market prices, it really just doesn't get much better than that. And the reason is obvious. These insiders have all sorts of material, non-public information that's available to them that is not available to those of us on the outside. And by law, they have to file with the SEC a Form 4 stating how many shares of their company they bought, on what day, at what price, and so the rest of us know immediately since it's filed electronically. And lots of academic studies have shown that the best performing stocks are the ones that the insiders are buying for themselves. So one of the things that I do is I watch the insider activity very closely and then recommend to readers some of the companies that the insiders are buying for themselves.
That's a great strategy, following the insiders and being able to make the moves the way they're making moves. But in your opinion, what would you suggest between large cap stocks, mid cap stocks, and small cap? For me, especially when I was a little younger, I would want to just put all my money into this huge speculative stock that could make me 1,000% return. And it's really exciting. You're like, man, I could put a couple $1,000 or 5,000, whatever that number might be for you, and you invest it, and it turns into this big, monstrous gain. And in reality, that kind of investing makes you lose a lot of money over the long term. And in your experience, what's a good portfolio strategy, even when things are going bad and you have things going good? With diversification and things like that works the best over time, because I was reading something a while back, and it was talking about the dumb money versus the smart money, and the smart money being the financial advisors and the ones that are really looking into everything and losing people money, versus the dumb money, which, let's say, just buys the S&P or the Dow, and over time they're up pretty significantly.
Mm-hmm. Well, I might say, first of all, I worked on Wall Street for 16 years, and I would question whether the smart money is really on Wall Street. Between the fact that they've blown up their own companies at Bear Stearns and Lehman and seen whopping losses at J.P. Morgan, right. I don't think they're nearly as smart as we sometimes give them credit for. And I would also argue, as I was saying a minute ago, that the really smart money are the insiders who know more about their company and its prospects than anybody else possibly could. Right. But to get to your question, small cap, mid cap, large cap, which immediately just essentially means small, large, or medium-sized companies. Right. Small being less than $1 billion total market capitalization, medium being 1 to say 6 or 7 billion, sure. Any bigger than that being a large cap company. I actually you should diversify among all three types of companies, small, medium, and large. But I actually think the sweet spot of the market is the mid cap stocks, and I'll tell you why. Companies like GE and Walmart and IBM and Dow Chemical, big behemoths, they tend to be stable companies, but they're simply too big to grow at the rate they did when they were smaller. The world catches up with them, and you have $100 billion in annual sales. You simply just can't grow at 50% a year anymore. Sure. Small companies, on the other hand, as you pointed out, tend to be risky. Often they're unprofitable, and big companies come in and often eat their lunch, and so they tend to be risky. So I like the mid-cap stocks, which are small companies that have grown enough that they're no longer small fry, but they're not so big that they can't grow at the rates of smaller, friskier companies. So I think the mid-cap zone is a good place to be most of the time. And actually, right now, given that we're we're 4 years into what I call the most disrespected bull market in history. I think mid caps are probably a good place to be. The small caps have had a big run. The mid caps are probably likely to lead the market higher from here.
Alex, do you ever look into dividend-paying stocks? Is that part of your portfolio strategy when it comes to looking for something that you will see some residual income from?
Yes, absolutely. In fact, over time, dividend-paying stocks have outperformed non-dividend-paying stocks by a wide margin. So, in addition to the fact that you're getting paid every quarter or at least every year with a dividend-paying stock, and those dividends tend to rise by at least the rate of inflation over time. You've got greater financial stability. You've got companies who obviously have a regular cash flow where they couldn't pay those dividends out. And historically, dividend-paying stocks have been great performers. So you shouldn't be focused on the dividend alone, but is the dividend one component of a smart security analysis on a stock? Yes, absolutely.
Something you wrote recently on Investment U is being a contrarian and how not to get too caught up in that and riding the trend. Can you kind of explain what that meant and what you were talking about when you wrote that?
Yeah, well, first of all, let's define our terms. A contrarian is someone who moves opposite of the crowd. So someone who was selling real estate instead of buying it a few years ago when people were thinking that they're not making any more land, real estate always goes up, et cetera, did very well. In early 2009, when the Dow was crashing and hitting 6,500 and people wouldn't touch stocks with a barge pole, a contrarian stepped up and said, gee, things are cheap, it will probably get better eventually, and act as a contrarian and bought. So a contrarian is someone who moves opposite the consensus. What I was saying in that article is, while it is very profitable to be a contrarian, when the market reaches extremes, extremely high valuations, you want to be a seller, extremely low valuations, you want to be a buyer. Especially if that high valuation is combined with euphoric sentiment and that low valuations are combined with great pessimism, you almost always have a clear signal as to what to do. But the reason I said you shouldn't be a contrarian all the time is that most of the time the market's in a longer-term trend. For instance, we're essentially in a four-year bull market as of the first week of March. We hit the 4-year anniversary. I think it was March 9th when the market bottomed out. And I call it the most disrespected bull market in history because as I talked to friends and family members and even readers, a lot of them have sat out this huge move in the market. I mean, it's more than doubled, and they've been sitting on the sidelines. And usually bull markets don't end until everybody's gotten in. So when I say don't always be a contrarian, don't just say because the market's going up, I'm going to get out, or because it's going down, I'm going to get in, because those trends will continue. It's only when the market reaches an extreme that you want to put on your contrarian hat and go opposite the crowd. But even then, you're not going to time it perfectly. If you get out of the market, you can expect it to keep going higher for a while. If you get in, it's probably going to go lower for a while. But ultimately, values will prevail and prices will return to where they should be. So you want to be a contrarian at market extremes and a trend rider during the majority of the time when the market's in a pronounced uptrend or a downtrend.
I really appreciated that article and that piece you wrote. It reminded me to not be so contrarian to the fact that it blinds your vision and ideas and possible investments that you can be in, that I could be in, and still make a lot of money. Because sometimes I think we get such tunnel vision on what we want to do well, what we want to be investing in, that we neglect the real bull markets or trends and bull markets that are out there that we're not taking action on. And I know there are a lot of people who missed out on the 2009 to 2013 bull market in the U.S. sector. I mean, you could have more than doubled your money just investing in the S&P and Dow Jones and things like that. So definitely looking out for those trends and not necessarily getting in right at the bottom and getting out right at the top, but investing in those trends and be contrarian when the bubble comes, when the euphoria hits, just like you said. That was great. Well, Alex, it's been a pleasure talking with you. Thank you so much for joining me today. If any of our subscribers and listeners would like to get more information and learn more about you, where could they go?
Probably the best site would be investmentu.com, and that's just investment and then you, the letter U.com. I'm the chief investment strategist of that free e-letter, and they can read my opinion on stocks, bonds, interest rates, currencies, commodities, all of what's going on. And as I said, it's a free service, and we welcome them signing up.
Thanks a lot. I appreciate you coming on the show today.
All right. Thanks for having me, Kenneth.